Hi everybody, and thank you for joining Othership's workshop today on how to file your self-assessment. Today's expert will be Stephen Tanner from Leap Accounts and Outsourcing. We use Stephen Othership ourselves, and if you want to find a partner offer on how you can work with Steve from Leap Accounts after this event, then please do check this out on the Othership Partner Perks page. You can find this at othership.com/perks. Othership is a flexible working platform comprised of 4 solutions. The first of those being on-demand workspaces that you can book by the hour or day wherever you are for you and your team. We also have a concierge service for people who are looking to find that ideal perfect office or a local membership in a co-working space. Our concierge team will be really happy to matchmake you to your perfect workspace and private office. If you want a mix of the two as an organization, so you have a base and also access to remote workspaces as and when you need, then we're able to provide a hybrid solution that combines the two of these together. And lastly, it's all about collaboration and knowing who is working from where, whether it's your own office or any remote location anywhere. Then we support you with our hybrid workspace management software. If you want to learn more about these, please check out the links below in the description. Otherwise, over to Stephen to bring up the slides and start today's workshop.
Hey guys, as Ben kindly introduced me, I'm Steve. I'm the Managing Director of Leap Accounts and Outsourcing. And yeah, going to do a presentation for you guys today on how to complete your self-assessment. So let me just share my screen. So yeah, this presentation is largely, it's an overview of kind of self-assessment, what needs to be submitted and how it should be done. Obviously, as I said, these calls, presentations, because I am largely going to go through the slides because it's kind of key not to miss anything. If anyone has any queries, just feel free to jump in and ask a question. I'm quite happy to kind of jump on and off the slides, and hopefully that makes things a bit more interesting. So yeah, but on that note, I'll get started. So what is self-assessment and who needs to use it? So self-assessment is basically the mechanism of reporting to HMRC your taxable income for the year, and as a result, what you owe them. There are a number of reasons you might need to submit a self-assessment, and there's a number of reasons you might not have done so in the past. So in summary, if you've always been an employee, your kind of income is taxed at source. That means kind of through payroll, and therefore you wouldn't have needed necessarily to submit a self-assessment. Obviously, you guys being either members at Othership or having any link to Othership probably means you're in some form of either director of a limited company or self-employed, in which case chances are you probably do need to do a self-assessment. And that's presumably why you guys are on the call. So common examples of income you might have outside of payroll that would require you to do a self-assessment would be rental income, receipt of dividends, which would be on kind of profits from a company, receipt of any foreign income or trust income, or profits if you're self-employed as well. You also need to be registered even if you are just an employee, if you earn over 100k. One quick thing to note, I guess just to flag on what I've said, is if you are now doing a self-assessment but you're also employed still, a common mistake is to leave off your salary income from your self-assessment because it's already being taxed elsewhere. So just to flag that kind of bottom comment there. If that is you, you still need to include your salary on your self-assessment. You just also include the tax underneath, and that's the correct way to do it rather than leaving it off altogether. Tax rates and bands. So income is taxed at different rates depending on your band of earnings. So these bands can change slightly each tax year, which runs from 6th of April to the 5th of April. So what I've provided here is just based on 21-22, which is the tax year that ends, 5th of April 2022. It's not going to, there has actually been a slight change, since this for the upcoming tax year, which I'll address in a second. But for the current tax year, which is 21-22, so that's what you would be submitting in January. That's the deadline is January. These kind of rates are accurate. So the first 12,570 of your employment or savings or dividend income, that's covered by what's known as the personal allowance, which most UK taxpayers receive if you're not earning over 100k. If you earn over 100k, that amount does start to reduce, but that's kind of slightly outside the scope of this call. The next 37,700 of income is taxed at 20%, and the next 99,730 is taxed at 40%. It's there that this number has now reduced from 6th of April 2023, so the next upcoming tax year, per the budget that got announced a couple of weeks ago. But for now, these numbers are, yeah, for the upcoming tax returns, everything here is correct, but in the future, that's going to change. For dividends, they're also eligible for the personal allowance, and they fall into the exact same bands as above. The difference is they're taxed at a slightly lower rate. So instead of being taxed at 20, 40, and 45%, they are taxed at 7.5%, 32.5%, and 38.1%. It's worth noting employment income, that includes self-employment income as well, also incurs national contributions on earnings above £9,500, the exact numbers there, and anything earned above 50,000, sorry, earnings up to 50,270 are charged at 12%, and then anything above that at a further 2%. Again, there has been some movement this year on the national insurance rates, but per your last year's, the tax return you guys would be filing coming up, these amounts are accurate. But again, for next year, you just need to check how these have changed because they are going to change. Okay. So I thought it may be helpful to give everyone an example of how that's applied, because I'm very aware I just reeled off a lot of numbers that may not make a huge amount of sense. So if we use Miss A. Jones as an example, she earns a salary of 35k, has profits from her rental income of 20k, and dividends of 10k. So the first thing will always be the salary that's taxed. So the salary would, the first 12,570 of her salary is going to be taxed at 0% because that's covered by the personal allowance. And then the remainder of her salary all falls into the 20% band. So that 22,430 is taxed at 20%. Next up, you would consider her rental profits. So obviously she's got 20,000 in total, but of the 20% band, there's only 15,270 left. So that would be taxed at 20%, and then everything above that would be taxed at 4,730. Sorry, the remaining 4,730 will be taxed at 40%. Her dividends are then going to be taxed at 32.5%. So that's the same band as above the 40%. It's just that, as I mentioned a second ago, dividends are taxed at a slightly lower rate. I've mentioned there for illustrative purposes, I've ignored the dividend allowance. That's going to be mentioned later. Kind of, yeah, is important. Finally, Mrs. A. Jones will also pay national insurance on her salary. So 0% is charged on the first 9,568 and 12% on the remaining 25,432. I think one thing to flag here, I've kind of provided this outline to give everyone a bit of an understanding of how income is taxed. It's a lot of numbers. Don't feel like to do your own self-assessment, you need to know all of these. If you put the information into HMRC system, they work all this out automatically for you. I just think it's useful to kind of have that understanding so that at the end, when you put everything in, you see HMRC's calculation. Some of it might make a bit more sense, look a bit more familiar, because it will be using some of these bands and numbers. But don't feel like if you don't understand fully what I've just gone through, that's not necessarily an issue. So on to the kind of dates and deadlines and penalties for self-assessment. So the deadline for registering is the 5th of October following the end of the tax year you need to declare for. So if anyone had any income that needs to be declared for the last tax year ending 5th of April 2022, the deadline for registering would have been 5th of October. So hopefully, if that's you guys are already registered. If you're not, I'd suggest just registering now. To be honest, they don't always issue a penalty for it, and you're much better off kind of getting registered. And yeah, rather than just not submitting a return, which is going to kind of get you into more issues. Deadline for submitting is then the 31st of January following the end of the tax year you need to declare for, or 31st of October if you submit a paper return, but to be honest, very few paper returns are submitted these days. So to use another example, if you had taxable income in the year ending 5th of April 2022, the deadline submitting would be 31st of January 2023. So I imagine most of you on the call, that's the next return you guys are going to need to do. Deadline for paying is the same as the deadline for submitting, 31st of January following the end of the tax year, and there is a penalty for late payment. So it's 5% as soon as it becomes late, and that keeps increasing. So in essence, yeah, the penalties for submitting late and paying late just kind of increase the longer. So it's always a good idea to get that submitted, yeah, ahead of time. And there's kind of three main steps, and to be honest, HMRC don't make this as straightforward as they could, in my opinion, to get kind of registered and to even have the ability to file the self-assessment is a bit of a pain. Once you've got everything, the future years are a lot more straightforward, but as you're going to see here, it's a bit of a pain to get registered. Because yeah, what you need essentially is to register for self-assessment, at which point you get what's called a UTR. So you need taxpayer reference. One quick thing to flag is if you are going to use an accountant, that's kind of as far as you have to go, because once you've got that UTR, they can do the rest for you. But presuming you guys are on this call because you want to file yourselves, the next step is to then create a government gateway, which is an online login to access HMRC system. And then from there, you can then request access to your self-assessment using your UTR. Once you've done that, you then receive an activation PIN through the post and log back into HMRC's portal, at which point you can kind of access and file your self-assessment. You could also at that point like view any historic submissions, tax due, that kind of thing. So I'll go into each of those in a bit more detail now. So there's two different ways to register for self-assessment, depending on whether you're registering because you're self-employed, so you're a sole trader who runs their business, not for a company, but just yourselves, or for any other reason. So if you're registering because you're self-employed, so I'll just reply to Alex's question. Did you say the next self-assessment we need to submit is by 31st of January 2023 for the tax year 21-22? That's correct. So if you had any taxable income in the year ending 5th of April 2022, the deadline to submit the tax return to tell HMRC about that is the 31st of January 2023. So just jumping back, if you're registering because you're self-employed, you need to create a government gateway first. I provided the link there, so that's fairly straightforward. Once you have your government gateway, and just to flag, a government gateway is kind of like a username. So it's just a mechanism. I'm going to explain because this causes quite a bit of confusion. The government gateway user ID is just something that allows you to access HMRC's system. It's like an online login, whereas your UTR is your unique taxpayer reference. That's used to actually submit the return. So the two are different, and yeah, you need both. So jumping back, once you have your government gateway, you'll have an option to register for a tax. So you log in and it will say, yeah, register for a tax. You select self-assessment and yeah, kind of submit the registration. And the next step will be that you'll receive your UTR through the post. If you're registering for any other reason, you need to follow the link on my slide, and then you will receive a UTR through the post, and you won't need to create a government gateway ID at that point. That's actually the next step. So there's two slightly different mechanisms. But yeah, basically, if you follow those links, depending on what your situation is, it's fairly straightforward. So once your UTRs arrive through the post, if you don't already have a government gateway ID, so if you were the second option on the last slide, you need to create one. It works like a username and allows you to log into HMRC system to view a variety of different tax information, one of which would be a self-assessment. I think, yeah, I've kind of alluded to the codes and stuff, but I think that's what I addressed just now. Once you've successfully created or logged into your government gateway, you need to be able to add a tax, so self-assessment. If you select that option, you'll then be asked to enter your UTR and some other information. It does vary, but it's often kind of passport information, last known address, just anything that HMRC have on their system so that they can match it to you and make sure you are you. Once you've done that, they'll send an activation code through the post. So one issue can be if you've moved address and they don't know about that. Sometimes there's a bit of an issue because they're only going to send a PIN to your registered address that they know of, but they're normally quite, I think at the point you move, it does up to date, so that should be fine. So once you receive the PIN, you simply need to log back into Government Gateway, input the PIN that you've been given, and at that point, yeah, you're good to go. You've got access, you can submit a self-assessment, you can view historic returns, everything you need. In a lot of ways, that's almost the biggest hurdle. It's almost more confusing than submitting your actual self-assessment. And here's a few screenshots that I just thought would be helpful. So if you follow the link I provided on the last slides, you'll see here, this is kind of the 3 steps to creating a self-assessment, to creating a government gateway. So once that's all done, you're kind of good to go to actually submit your self-assessment return. So here's how that would be done. You would log in using your user ID to the government gateway, and you'll be presented with a page, something similar to this. Again, depending on your own situation, it might look slightly different, but this is generally how it's going to look. Yeah, if you go to complete your tax return, start now and tell us about you. You'll then be taken to a tailor your return. So this isn't actually this isn't you completing your return itself. It's telling some HMRC some information about your income. And what they then do is use that to create a template for you. And from then you can put in your income and as a result, draft your self-assessment. Please, one thing to note, because again, it often causes issues. If you own your own limited company and you kind of take dividends or a salary from that company, in a non-tax perspective, a lot of people consider that to be self-employed. In this situation, from a tax perspective, if you own a limited company and you receive dividends from it or salary, you're kind of an employee or shareholder of that limited company. You're not self-employed. Self-employed is only if you're a sole trader. So once you've kind of given the HMRC that information about your situation, they'll then automatically draft this tax return for you. It's kind of every section you need to complete, and then it's simply a matter of going through each section and just adding details about your income, whether it be employment, dividends, property income, etc. The most common section you'll need to fill in will be the employment income, especially again if you have your own limited company and you take a salary, which is fairly common. All of the information, if you're running payroll for your company, whether it's your own company or someone else, you'll have a P60 at the end of the year. So once the tax year finishes, 5th of April, most payroll software, all payroll software should create a P60 form for you. Your employer actually has an obligation to provide that. That will have your employer's pay reference, the employer name, and then all of the kind of income, tax, etc. that you need to populate this page. All other forms of income you'll need to enter should be done in a similar way, kind of working your way through everything that says not entered on that page. The sources of the relevant income will come from where that information will come from will differ for each income type. So for example, if you have rental income, that will come from the rental statements of your letting agent, as well as any bills or receipts you've paid for the property, mortgage statements, etc. Similarly, if you've been paid dividends, if you're kind of managing the bookkeeping for your business, you should probably know that number. If not, your accountant might, or if you've got someone internally doing the finance. Similarly, if you have investments, the platform that you hold all those investments, they'll normally provide you with an annual tax summary, and you can use that to populate your tax return. And another example would be capital gains. So for example, if you've sold a property that you don't live in, so it's an investment property, you're most likely going to have a capital gain to pay on that. If so, again, you'd need to declare that. Quite often, if that's the case, probably suggest speaking to an accountant because that's a bit more complicated. But that's where that would come from. And finally, if you receive trust income, you need to file an additional section on the return. So that's another situation where I'd probably suggest speaking to an accountant, simply because the self-assessment system where you can log in and do it online doesn't actually allow for trust income to be declared. So it needs to be submitted through software, which again, any accountant's going to have. So I would probably just touch base with them. With regards to redundancy payments, just to reply to Alethea. So redundancy, normally, if it's a true redundancy payment, and what I mean by that is it's under 30 grand, I think that's still the limit. And it meets all the requirements, so it's not contractual, for example. It's a true redundancy payment. That's actually exempt from tax and national insurance. And as a result, you don't have to declare it on your self-assessment at all. If it's a redundancy payment in terms of you were paid it when you left the business, but it doesn't meet the requirements of a statutory redundancy payment, as in it doesn't meet the requirements of being tax-free. So maybe it's over 30K or it was in your contract, etc. Then that should just be included on your P60, to be honest. So your employer should add that to your last payslip, should be included in your P60, and then you just declare it as if it was normal salary. But the majority of redundancy payments will be tax-free because they're under 30K and they're not contractual. So most likely, to answer your question, it probably doesn't need to be featured on the self-assessment at all. Okay, just jumping back to the slides. Once you've completed each section, you'll then be shown a copy HMRC's calculation of the tax you owe for the year and any other payments on account. I'll address payments on account in a sec. On this page, there's also an option to view and print your calculation, which will provide a fuller breakdown of the tax calculated. I'd always suggest saving this down because it's quite useful, even if, for example, if you do it your own this year. But aware this is difficult to kind of, I've kind of prepared the slides in a way so that you can look back at them and use them as you go through the return. So yeah, once you've viewed your calculation, you're happy with the tax due. Final stage is simply just to make those ticks. That coronavirus support payments is probably going to disappear after this year, but it will look something like this. Yeah, and then you are done. So now I just wanted to address a couple of other items related to self-assessment that are normally quite useful to know if you're submitting yourselves. So payments on account is the first one that often kind of throws people a bit. What a payment account is essentially a prepayment of your estimated next year's tax liability. So for example, if on your current self-assessment that you're going to submit soon, you have a tax bill of 5,000, you'll also need to make payments on account towards next year's tax bill, so the following year, of 5,000. And then in a year's time, when you submit that tax return, you've already paid 5,000 towards it. So use an example, if you now had 6,000 next year, you'd actually only have to pay 1,000 because obviously you've already prepaid for 5,000. So the payment on account is paid across 2 dates. So the 31st of January and the 31st of July. So using the example above, if this year you have a tax bill of £5,000, on the 31st of January, as well as paying your tax bill of £5,000, you also need to pay £2,500. And then on the 31st of July, you have to pay a further £2,500. So Alex, just to answer your question, payment on account is self-assessment related. So it's a prepayment of your self-assessment bill. There are relation to corporation tax, there are elements of payment on account, but it's a different thing. This is literally, to provide a summary of why it's required. HMRC basically, if you think about, if you're an employee, your tax is getting deducted every month. So at the point you're paid, your tax is deducted. For self-assessment, you're declaring it in the following January. So using this current year, any income you received in, let's say, May 2021, so the beginning of the last tax year, if there weren't payments on account, you wouldn't be paying the tax on that income you received in May 21 until January 2023. So there's a massive lag in how long you have to pay the tax, which is obviously quite a big benefit. So, and it just means HMRC get their money a lot later. So to minimize that, they're pushing through payments on account, which basically mean you get less of a benefit in terms of how long you have to pay your tax. Not everyone has to file a payment on account. So if your self-assessment bill is below £1,000, or 80% of the total tax is collected through PAYE, you won't need to make a payment on account. What that means, let's say you had a salary of £100,000 and you paid, let's say, £40,000 of tax on it. And then you also had rental income of £10,000, and which there was £2,000 of tax. Even though you've got £2,000 of tax, so that's above the £1,000 threshold, because 80% of the tax was through PAYE, as in the 40,000 I mentioned, you don't have to make a payment on account. So it's basically for people who they don't pay their tax through PAYE. If you know your next tax bill is going to be lower, you can also elect to reduce your payment on account. So for example, if you took a dividend of £200,000 in this year, for example, you have a very large tax bill. You're also going to have a very large payment on account for next year. If you know that next year you're not taking a dividend and therefore you're not going to have any tax, you can tell HMRC, I'm not going to have that tax bill, so I'm not going to make the payment on account here. So you don't have to make it. The problem is if you don't make it and then there is a tax bill next year, they'll charge you interest from the day you should have paid your payment on account to when you settle your tax bill. Something else I wanted to touch on is tax deductible expenses. So anyone who runs their own business as a sole trader, something I regularly get asked, I have X amount of income, what expenses can I offset against that? So I just want to provide a bit of an overview on that. So the first thing to consider is the wholly and exclusively rule. That's kind of the key overarching concept of what you can and can't include. And basically what that means is, was the cost you incurred directly and entirely in relation to the trade of the business? If it was, you can nearly always include it. If it wasn't, if there's a personal element for it, then you normally can't. As an example, if you flew somewhere for entire business purposes, so for a business trip, you're absolutely fine to include that cost. If you flew somewhere and you did a bit of work while you were there, met maybe a client, but the vast majority of the trip was for personal kind of leisure reasons, that's not wholly and exclusively a cost incurred for the business, so you couldn't include it. So that kind of thinking is the way to always consider if you have an expense and you're not sure whether it's a business expense. As an example of how this rule is applied, I've kind of actually just given another example off the cuff, but here's another one. Membership to private members clubs is quite a common one, or the purchase of a suit. They're ones that people often think they can put through, but HMRC would and historically always have rejected both of these, as although there is a business element to both. So obviously for the suit, you wear that for business. For the private members club, you might use that for networking. Because they aren't holding exclusively for the business, they kind of have a social element, and the suit can be worn for other reasons. They are both not allowed to be included. One quick thing to note on that: if there's a way to split the cost very clearly, that would be okay. So if, using my travel example, if you get to somewhere, a foreign country, for leisure purposes, and then you took a train to a different city to meet a client, that element would be allowable. Okay, so just moving on to some more common examples of expenses that can be included. So travel costs. Any travel outside of traveling to your main place of work is allowable. So as I've kind of alluded to, traveling to meet a client, traveling to pick up suppliers, anything like that is absolutely fine. And if it's petrol, you can claim 45p a mile for the first 10,000 miles you drive, but 25p after that. What you can't claim is travel to your normal place of work. So if you live on the outskirts of London, you have an office in Zone 1, you get the train there every day, that's not an allowable expense because it's deemed to be traveling to your place of work rather than a business expense. Moving on to subsistence. If you're grabbing something to eat while en route to meet a client or whilst you're providing your trade or service, again, that's absolutely fine if it's not at your normal place of work. One thing that isn't included, however, is client entertaining. So if you take a client out, that's something you won't get any tax relief on. That's which people are probably thinking that seems unfair because it is holding exclusively for the purpose of the business, which I agree. It's just a specific excluded kind of cost that you just can't include. Moving on to working from home expenses. As a sole trader, work from home costs, so that's gas, electricity, water, internet, can be included as deductible expenses. What you'd need to do is track the total cost and then apportion it based on kind of the work versus leisure activity. So as an example, if you have an internet cost of £50 a month and you think you use it 50% for business, 50% for leisure, you'd include 50% of that cost. One thing to note is if you're a director of a limited company rather than a sole trader, the costs of what you can include as a company expense for work from home are a lot more restrictive than that. So this is just in relation to being a sole trader. Anything else that relates directly to your trade, so software, IT, advertising, marketing, staff costs, they're all absolutely fine because they're holding exclusively for the purpose of the business. Other common claims are just small things that you can do to reduce your tax. So trading allowance. So if your self-employment or sole trader income is less than £1,000, you're eligible for the trading allowance, and as a result, you don't have to pay any tax on its income. This is normally used if someone's employed, so they have a salary, that's their main source of income, which is taxed. Then they also have £1,000 where they kind of do, a bit of consulting on the side or something, or the same for rental income as well. That's allowable. You don't have to pay any tax on that £1,000 of income. Another common one is rental room relief. So if you own a property, you live in it, but rent out the rooms to someone else, so often like a friend or a colleague, if that rental income is less than £7,500, you can be exempt from paying tax on that, which again is actually quite beneficial because it's quite a large saving. Next is the dividend allowance. So this is actually another one that's going to reduce in the upcoming tax year. But currently, if you earn £2,000, the first £2,000 of dividends you earn, they're always going to be tax-free, no matter what the situation. And if you own a limited company, it's therefore always worth discussing with your accountant the best way to benefit from this. So even if you pay yourself salary primarily as your source of income, it's worth taking £2,000 of dividends from the business if you can every year because it's tax-free. A few other ones to consider. So rental income, if you pay interest on your mortgage, tax relief, you can get tax relief on that mortgage interest. However, it is restricted, so you don't get full relief. Again, it's something worth just flagging to your accountant. But yeah, mortgage interest is something you get relief from. Charitable donations are something else to consider. So if you donate to a registered charity, so that's registered with gift aid, you receive automatic basic tax relief. So that means if you're a 20% taxpayer and you give a charity £80, it automatically, the government top up an extra amount, and the charity would actually get £100 in that situation. If that's the case, you're a basic rate taxpayer, you don't need to do anything. You can basically be happy in the knowledge that you gave £80, but the charity got £100. But if you're a higher additional rate taxpayer, so you're paying tax at 40 or 45%, you can actually kind of put these charitable donations on your self-assessment, and you'll get additional tax back because you're paying tax at a higher rate. Finally, pension contributions. So in most instances, contributions into a pension scheme are exempt from tax. So simply put, if you earned 100 grand, paid 20,000 into the pension scheme, only 80,000 would be subject to income tax. Normally this is done through payroll, and it's kind of all done automatically, so you don't need to do anything. But certain schemes don't deduct all tax, they just deduct kind of a 20% credit from what you pay into the scheme. And then as a result, if you're a 40 or 45% taxpayer, you've only received 20% tax relief on that contribution, and you can claim the rest back through your self-assessment. So again, it's majority of pension schemes, it's done automatically. It's just something worth checking with your employer, because it may be a good way to get some tax back. Okay. Next up is how to pay your income tax. It's fairly straightforward. There's plenty of ways to do it. You can pay by check, direct debit, online transfer, telephone transfer, or branch transfer. Or when you submit your self-assessment, there's kind of a link and it says pay now, and you can literally just follow that, put your credit card or debit card details in, and pay everything that's needed. I have provided a further information slide, and there's a link that takes you to all of the HMRC's options to pay. One thing I want to flag is, as I've kind of alluded to, in some situations it does make sense to use an accountant. Other times, if it's a very straightforward return, it's definitely something you guys can do on your own. Main reasons people choose to use an accountant are peace of mind, because you know it's been done correctly, and there's just kind of someone to talk to if there's any issues with HMRC. Second one is time. Some people, they know they could do it themselves, and they don't want to spend half a Sunday doing it. They're just happy to pay someone else to do it for them. And finally is complexity. That's where, if you have trust income, rental income, maybe some foreign income, that kind of thing, it's just makes sense to make sure you've got an accountant doing it. A, because it'll be done correctly. B, they may spot a relief or something they can do to minimize your tax, and that alone is almost certainly going to pay the cost of using an accountant. That's everything I had, but I'm more than happy to answer any other questions if anyone has. I've just seen it. So with regards to Paolo, with regards to rent abroad, that is still taxable. So if you're a UK taxpayer, even though it's foreign rental income, that's still fully taxable in the UK. So you declare your rent less any expenses. The key thing to note though is any tax you paid abroad is deducted. So as a very basic example, if you had £10,000 of property profits, so income less expenses, £10,000 in the UK, you put that into the HMRC system, and if they said you have £2,000 tax bill on the rental, for example, let's say it's Spanish rental income, if you've already paid £1,500 or the euro equivalent in Spain, you could deduct that, and therefore you'd actually only pay £500 of tax. If you've actually paid more in Spain than is due in the UK, then obviously there's no tax to pay. And just to answer Alex's question, so Alex, the reason a sandwich working from home wouldn't be allowable as subsistence, anything in what's deemed to be your usual place of business, kind of food or travel costs there aren't allowed. So in the same way that traveling to your office in London wouldn't be allowed because that's your usual place of business, if working from home is your usual place of business, you wouldn't be able to claim a food cost on that. I think quite a lot of people probably do, and they probably don't realise that rule. But technically it's not allowed. So food costs are allowable when you're traveling outside of your usual place of business. So if for example, me as an accountant, if I went to visit a client in Reading and on the way there I grab a sandwich, and then while I'm out kind of working in the client's office, I nip out to a cafe around the corner and grab some food there, that's completely allowable. if I'm at home in my usual office where I am right now and I nip around the corner to buy a sandwich, that's not allowable. Okay, in which case, yeah, I'll hand over to Ben, but as I say, if anyone has any queries, feel free to fire me an email. I think my contact details should still be on the screen.
Thank you very much for joining today's workshop with Othership. It's been great to have you here. Any presentation material that was shared with you today will be emailed out to you afterwards, along with links on how you can follow up, learn more about Othership, and get in contact with your expert from today. Thank you so much. I look forward to seeing you in an Othership workspace, in Slack, or around the community.